Hi, I've seen your advertisement requesting applications for the post of accounts teacher at Dubai. The advertisements also requested us to share our resumes along with the demo video clip. So I share my resume along with the demo video clip. So please find it. Thanks in advance for listening to me. First of all, I would like to introduce myself. My name is Hari Krishna. I belong to Andhra Pradesh, India. I'm a chartered accountant qualified in May 2016. My first job was at Nigeria. I worked for an oil and gas company as an accounts payable manager. Thereafter, I have been working in Angola for an FMCG group looking after MIS and accounting operations of 4 manufacturing plants. I believe my experience would help me to cater education industry more efficiently, and I also believe that I have teaching abilities, but it is you who have to decide if I've got those abilities after listening to this demo video clip. You might also be interested in knowing the reason behind changing my profession. All through my employment, facing problems with the politics in the work environment, which I don't like. So I want to lead a happy life while enhancing my knowledge and teaching students. And I also have some educational obligations to complete my SCCA, and that is it. Coming to the demo video clip, I would like to make you understand the concept of deferred taxes. I chose this concept because it has got all the complexities. The audience need to be aware of all the accounting concepts and income taxes too, to understand the concept of deferred taxes. International Accounting Standard 112 deals with deferred taxes. I'm not going to go deep into the standard, but I would like just make you understand the concept of deferred taxes. Let us try to understand the word deferred tax. Defer means postpone. Tax means it's an expense to the business. Deferred tax means postpone the expense. Do you really postpone your expense? I mean the tax expense? No, you will not postpone the payment of taxes, but you will postpone to treat tax as an expense. How would you postpone to treat tax as an expense? And from this concept, the deferred taxes arise. Deferred taxes arise mainly because of temporary differences between the timing differences between the book profit and the taxable profit. Timing differences in the sense, in your books you may claim n number of expenses, but for income tax computations the Act doesn't allow you to claim all these expenses, or it allows you to claim upon fulfillment of certain obligations prescribed in the Act. Let us analyze two expenses to understand the concept well. In the first instance, we take donation. Section 37 of the Indian Income Tax Act doesn't allow you to claim donation as an expense. It won't be treated as a business expense, so it doesn't allow you to claim as an expense. And because of this, there is a difference between the book profit and the taxable profit. But this is a permanent disallowance. You will not claim it forever. Now let us understand in case of another instance, we take bonus to employees. You may create provision for bonus to employees in the current financial year, but under the Income Tax Act, you will be able to claim it only if you fulfill an obligation prescribed under the Indian Income Tax Act. And the obligation prescribed it, whatever the provision you have created, needs to be paid on or before the due date of filing the return. The tax return. If you could not pay the provision on or before the due date of filing the return, you will not be able to claim it as an expense. And because of this, there is a difference, and this is a timing difference. So in this current financial year, you will not be able to claim it if you could not pay it on or before the due date of filing the return. and if you could pay it after the due date of filing return, it will be allowed in the next financial year. So there is a timing difference in claiming this bonus as an expense, and because of this the deferred tax arises. How? It means in the current financial year you will end up paying higher amount of taxes. The extra tax you pay because of not claiming this bonus as an expense will be treated as a deferred tax, because in the subsequent financial year you will claim this disallowed bonus as an expense in the subsequent financial year. There you will end up paying less amount of tax. Actually in that financial year you are supposed to pay the tax calculated for that financial year, but you will pay less amount of tax because of claiming this as an expense in addition to that financial year. So in the subsequent financial year the expenses would be the expenses of that financial year plus the amount which was disallowed in the current financial year. So in the next financial year your tax amount will be lower, and in this current financial year your tax amount will be higher. If you add the both, the tax of this current year and the next current year, it will be same, but there is a timing difference. In this year you will pay higher taxes because of not claiming this bonus as an expense. In the subsequent year you will pay less amount of tax because of claiming this expense, because of claiming this bonus as an expense. When I say higher amounts of tax and lower amounts of tax, I am comparing it to the book, the tax you calculate as per your book profit. So any extra amount of tax you pay because of not claiming this bonus as an expense in the current financial year will be treated as a deferred tax and deferred tax asset. Any amount of tax which you will not pay in the subsequent year because of claiming this bonus as an expense which was allowed in the last financial year will be treated as deferred tax liability. So in the current financial year you have created deferred tax asset, and in the subsequent financial year you have created deferred tax liability. These two will get set off and the effect will be nil. This is what it is. Okay, now let us try to understand the concept of deferred taxes through this example. Let the financial year be 2021 and your assessment year will be 2022. Due date of filing return for the financial year 2021 would be 30/6/2021. Just we are assuming this one. Now we see the profit and loss statement for the year 2021. Under revenue, let your sales be 100,000, interest income be $5,000. So the total revenue is $105,000. Now let us see your expenses. Under your expenses you have 20,000 of your rental expenses, 15,000 of insurance premium which was paid on, focus on this is relevant to deferred taxes. Insurance premium paid on 1/7/2021, that is after the due date of filing return. You are supposed to file your income tax return for the financial year 2021 on 30th June 2021. You have incurred your insurance premium for the year 2020-2021, but you could pay it only on 1st July, that is after the due date of return. Okay, just remember this. Now the donation is 5,000, salary is 10,000, and the total expenses comes to 50,000. Book profit is 55,000. Income tax, we'll see this part later. Now, so your book profit is 55,000. Now let us see the computation of taxes. As we have seen, the book profit is 15,000. And from this book profit, you are supposed to add all your disallowance of expenses, and there is a mistake here. Less all your allowable expenses. I mean, what we do is we have taken our book profit, and to this book profit we add all disallowance, all expenses which are disallowable under the expenses. That is, we are increasing the profit. When expenses are disallowed, your profit will get increased. That is what we are doing here. So let us analyze your expenses. Your expenses are rental income, rental expenses. You have incurred 20,000 of your rental expenses will be allowed under income tax act. So there is no problem with this. There won't be any differences in case of rental expenses. Insurance premium paid on 1/7/2021. You need to analyze this insurance premium, because section 36 of Indian Income Tax Act says that you will be able to claim insurance premium only if you could pay it on or before the due date of filing return. On or before, that means the due date of filing return is 26/2021. Return means the income tax return. The due date of filing the return is 36/2021, but you could pay this insurance premium only on 1st July 2021. That is after the due date of filing return. So you will not be able to claim this as an expense. Consequently, your profit will get increased as per Income Tax Act. Okay. Then donation. Donation is not an eligible expense under the Income Tax Act. So this is a straight disallowance. You cannot claim it forever. At least you can claim this in 2022. I mean, at least you can claim this in the year 21-22. In this financial year, you can claim it. And only if you pay it. Okay. But this donation, you cannot claim it forever, because the Income Tax Act straight away disallows it. And there's no chance of claiming it anyway. Salary is 10,000. It is an allowable expense. Okay. So now we go to the computation of taxes. So your book profit is 55,000, and your donation, add it back to your profit, because it is not allowed. This expense is not allowed, and you will not be able to claim it as an expense. So your profit get increased to the extent of 5,000. So 55,000 plus 5,000. And insurance premium, as you could not pay it on or before the due date of filing return, you need to add it also. So you need to add total 20,000 of your expenses. You need to add back 20,000 of your expenses to the book profit. So now the taxable profit is 75,000. Your book profit is 55,000 and your taxable profit is 75,000, because the Income Tax Act is not allowing you to claim this donation and insurance premium. Donation, you cannot claim it forever. Insurance premium, you'll be able to claim it in the next year, because there is an eligible expense. Insurance premium is an eligible expense, but with certain obligations, and you could not fulfill those obligations in the year 2021, and you could fulfill those obligations only in the year 2022. So you'll be able to claim it in the year 21-22. Okay, but in the year 2021 you will not be able to claim it, as you could not pay it on or before the due date of filing return, which is an obligation prescribed under the Income Tax Act. So your taxable profit is 75,000. Let the tax rate be 30%, and your income tax comes to 22,500. 22,500. So you need to pay 22,500 to government. So we'll see the entry for this one. You need to pay cash to government to the extent of 22,500. So credit cash 22,500, which goes out of your books. Now the income tax is only 18,000. Income tax is only 18,000 as per your books. Okay, and the deferred tax asset is 4,500. Everyone will get a doubt that the income tax computed is 22,500, but why is it only 18,000 that has got debited? Because if you analyze your expenses, that insurance premium you have incurred in the year 2021, and you are supposed to claim it as an expense, but it is the Income Tax Act that is not allowing you to claim this insurance premium as an expense, but because of not fulfilling certain obligations. But if you analyze this insurance premium belongs to 2021. You can claim it. This is an eligible expense. So your book profit should be after claiming that expense, after claiming that insurance premium. So actually speaking, your income tax should be only 18,000. You are liable to pay only 18,000, but you are paying 22,500 only because of not claiming this insurance premium as an expense. This is the timing difference. You're allowed to claim this in the next year. So you are ending up in paying high amount, 22,500. Income tax is 18,000. And the extra you pay 4,500 which is not your expense, but it is a deferred tax asset which you are not supposed to pay, but you are paying because your Income Tax Act is not allowing to claim insurance premium as your expense. So you are ending up in paying 22,500, but you are supposed to pay only 18,000. So this being your asset means it is recoverable. Something like recoverable. You're now supposed to pay, but you're paying it. Okay. This is for the year 2021. Now if you see the year 21-22, financial year 21-22, assessment year 22-23, and due date of filing return is 36/2022. And we'll adopt the same profit and loss statement as of 2021. Sorry, there is a mistake here. 21, 22. Okay, we'll adopt the same numbers. We'll adopt the same numbers from 2021. That is sales. Let it be same like 2021. That is $100,000, and interest income $5,000. Expenses same, but observe the difference that insurance premium for the year 21-22 you could pay it on or before your due date of filing return. Your due date of filing return for the year 21-22 is 36/20/22, but you could pay it on 29/6/20, that is on or before the due date of filing your return. So you'll be able to claim this expense as per your Income Tax Act. Now there is no problem, there is no difference, there won't be any timing difference. So rental expense you'll be able to claim it, insurance premium you'll be able to claim it, donation 5,000 you will not be able to claim it because this is not an eligible expense, it is disallowed under section 37 of the Act. Salaries you will be able to claim it. 55,000 is your book profit. Now let us see the computation. Book profit as for books is 55,000. Just adopt that one. And disallowance of expenses. You have to analyze each of your expenses whether it is eligible under Income Tax Act or not. Donation, it is straight away disallowed, so add it back to your profit. Insurance premium, this time, that is in 2021-22, you could pay your insurance premium on or before the due date of filing return, so you will be able to claim it. So there won't be any problem. This is the same as per your computation and income tax computation. 20,000. And allowable expenses. Here is what you have to observe. You will be able to claim this 15,000, which was disallowed in the last year. In the last year's computation, we have disallowed 15,000 of insurance premium, which could not be paid on or before the due date of filing return for the year 2021. So now you will be able to claim it. I mean, last year it was disallowed because you could not pay it on or before the date of filing return. You paid it on 1st 7/2021. Okay, 1st July 2021. So you'll be able to claim in this year. So your taxable profit will be 60,000. Your taxable profit got reduced because of claiming this as your expense. Now the tax rate is 30%, income tax is 18,000, and your book tax is 22,500. Your income tax got reduced only because of this extra allowance, which was disallowed in the last year, and you will be able to claim it in this year. So if you see, the government is asking you to pay only 18,000, but actually you are supposed to pay 22,500 as per your books. So the difference is deferred tax liability. Last year we have created deferred tax asset of 4,500, which is because of not claiming that insurance premium as an expense. Last year we could not claim insurance premium as an expense because we didn't fulfill the obligation. We could not pay it on or before the due date of filing the return. So last time it was disallowed, and in the current year it will be allowed. So as you claim that insurance expense in the year 2021, you ended up in paying less tax, 18,000. So difference is deferred tax liability. So now pass a set of entry that last year we created a deferred tax asset, that is we are not supposed to pay it, but we paid it in the last year. In the last year, we are not supposed to pay it, but we have paid it. We are not supposed to pay it, but paid it. That means we debited to asset account. Now credit that asset account. In the year 2021, we are supposed to pay, but we didn't pay it. We are supposed to pay 22,500, but we paid only 4,500. We paid only 18,000. The difference is 4,500, which we are liable to pay. So debit this liability. So debit this 4,500 and credit the last year's deferred tax asset. So this is got set off and there is no deferred taxes now.